Okay, ladies and gentlemen, thank you for joining us this afternoon. My name is Michael Camo, and I'd like to welcome Steve Smith to the Minyanville Show. Steve has been trading options for over 20 years. He is the author of the Option Smith newsletter, which has beaten the S&P for 4 straight years, and he's up 39% year-to-date. Now, Steve has an encyclopedic knowledge of options concepts, and he's the guy I always turn to when I have questions with options, and it's safe to say he's helped me avoid quite a few messes over the years. We like to call Steve the Volvo of options because he's slow and steady, but he's always on time, and he proves you can make money in options without gambling or doing anything too crazy. So, Steve, how are you doing today?
I'm doing all right, and I will say that lesson of trying to be slow and steady came after not being slow and steady and having a few blow-ups early in my career when I could kind of afford it, and I was learning my way around options. And so everything we do today is probably going to be about risk management. So.
Okay, and now just to remind people, the reason you want to be a Volvo is you'll see on the road there are people with Volvo 240 station wagons with 400,000 or 500,000 miles on the original motor, and that is the goal. Okay, so we are going to move on quickly. We already did a bio. So let's get to the most important thing. It's very easy to get in trouble with options. So why don't you tell us a little bit of how to avoid blowing up?
Again, it really starts with the risk management, and to skip around from where this is, not to go in the direct order, but it's setting up a position that has a limited risk, and even if you have something that has a limited reward. The great thing about options are they tend to be probability driven, and you want to try and get the probabilities in your favor. I'm not a baseball fan, but that's a probability game, like most other sports or casinos, gambling, and that's why we talk about hitting singles or doubles. And if you can earn 3% a month and do that consistently, at the end of the year, you're going to have a very nice year relative to almost any other asset class. It may not be as sexy as being a stock picker or loading up on out-of-the-money calls and saying I earned 30,000% on something, but at this stage you really want consistency, which will lead to longevity, and so that's kind of how I've evolved in my trading. I used to do a lot of things that was selling options naked, buying out-of-the-money calls, puts, and looking for a home run or easy money in Decay, and you can make money for a couple months in a row that way, or lose money multiple times and then hit a big one. But over time, I don't think that's the way to go.
Okay, so why don't we move on to portfolio construction, because I feel like a lot of people, especially if they're used to investing in plain old stocks and mutual funds, they don't know how much of their portfolio should be in options and how much should be in position. So, I guess, how would you recommend that people start in terms of allocations?
I think it's kind of a little nuanced here. I mean, we're making the assumption that anybody who's listening to this has some degree of sophistication in terms of their investment knowledge and knows options a little bit. So, on the super aggressive side, you may want to say, you know what, I want to basically construct my portfolio of all my investment assets with a heavy weight in options. And actually, a recent article that I had talked about a replacement strategy. Rather than owning stocks, use calls or puts instead. It's it's a way to reduce risk, boost returns, which is the classic catchphrase for options. So in that case, you may want to have let's say you have $1 million of investment savings. You may want to put 50% right into just an option-based portfolio. But that's not for everybody. That would be for somebody who's really going to be able to watch it all the time. And then within that, you're going to still, even if you're going to be that aggressive, you're going to still want a typical 401k, IRA, and some other alternative assets, things like that. You know, what I look to do in the option Smith portfolio is kind of a hybrid of, it can be like a bolt-on to traditional owning an index fund, having some specific stocks that are core holdings, and then bolting this on to try and add some alpha to your returns. And then within that portfolio, I only allocate 50% at the most at any given time. So, and then within that, we drill down a little bit more. I only have one position. Any one position is no more than 5% of that portfolio. So again, this goes back to risk management.
So, I mean, so just to be clear, do you think people, especially when they're starting out, they should be more concerned with the downside risk than, you know, dreams of riches?
You never want to have dreams of riches. This would go back to be modest in your expectations. 3-4% a month is not dreams of riches. It's about longevity and you know, earning income over the long term. And you could ratchet that up through different strategies that we'll get to that have very high risk reward. That, you know, even if you only earn that, then you boost your alpha. But the risk is the first part. I mean, especially nowadays, capital preservation is the key. So even if you construct a portfolio that's mainly based on options, you want to have that measured risk. And my feeling is you can measure that risk with options a lot better than you can if you're just using stocks. You know, there's so many ways to hedge, protect, limit risk. I know exactly what you're looking at in terms of profit loss time frames.
Okay, so let's move on a little bit to hedging because you know, with the S&P so high and now it looks like it's cracking a little bit. You know, first we'll talk about some, I guess, more conventional strategies. And why don't we talk about you know, just straight out puts, because the VIX has been near historical lows. So assuming somebody is freaked about the S&P, let's say going to 1,600 in 2 months, or alternately up to 2,000, like how do you feel about just plain old at-the-money puts and calls?
You know what? In my time, I've started to simplify things and use simply at-the-money puts and calls, rather than get all convoluted and think I'm going to, you know, the more pieces you add to the puzzle, the more complicated it can get. So assuming you have somewhat directionally correct and somewhat of the timing correct, it's really going to work out for you to just keep it simple. The other piece to it, I don't know if we can go back and look at the page that talks about the pricing. You know, that you do need to understand pricing concepts and what goes into pricing an option. I think if you go back to page 2 there.
Yep, we got it up.
So in that sense, you know, you want to look at something with implied volatility is low. You know, understand that realized or historical volatility is backward looking. Implied volatility is forward looking. These two ultimately will end up reverting to the mean. The other thing you want to know about is time decay is a huge impact, and it works on a slope, is that it accelerates as it works towards expiration. So that again, that puts the timing factor into what you're doing. Are you looking for a trade? Are you looking for a longer term investment? And that's how you're going to pick your expiration date. And the one other thing about that is you always know your delta. That's probably the other Greek. So if you have, you know, the big is understanding the delta and what to expect from when the price moves on the underlying, what you think the the price of the option should move. So, and that's also part of risk management. So,
okay, I just want to remind I'll let people know that Steve actually wrote an educational series on Minyanville called 9 Weeks to Better Options Trading, and it has a lot of really depth information on issues like implied volatility and time decay and all the Greeks, which are the very basics that you should know before you ever place an options trade. And when we send you the replay of the webinar, we will include a link so you can read all that stuff. And a lot of it is, would take up too much time to simply explain here, so you'll be able to read it at your leisure.
Okay.
Yeah, exactly. This is a lot to throw out. So one of the things that we can get to that Michael just mentioned is in terms of how to allocate, how many contracts to buy. You want to look at delta and say, this is my exposure. This is what I want, not money. You don't want to do a notional value. You want to look at the delta that you're willing to get your exposure there. So, okay.
Okay, so we are going to move on.
Let's do some butterfly spreads.
Now, butterfly spreads are my favorite option strategy in the world, because a lot of times for like $5 or $10 you can buy yourself a lot of entertainment on Friday afternoon when you're hoping something lands on expiration. So Steve, why don't you we're going to get into the structure, the mathematical structure, but Steve, why don't you give us a brief intro to butterfly spreads?
Okay, butterfly spread is basically two spreads, both if you're buying a vertical spread and selling a vertical spread with a common strike price in the middle. So you can look at it this way: long a vertical spread, short a vertical spread, with a common strike price in the middle. That's typical. That would be a long spread. That's the way most people use them. And let's see, you have a Twitter example up on the board here. In this case, what do we have? It's this one cost us $1.10 is the net debit, and the maximum profit is $3.90, which would be achieved if shares of Twitter at 55, the middle strike. It's the middle strike at expiration. Now here's the big drawback. Because you have two offsetting spreads, a butterfly is basically immune to changes in volatility, changes in time in the front early on. So you really can only achieve the profit once you get very close to expiration, almost to the day of expiration. So they're very stable. Some people will like to use butterfly spreads as, well, let's stick with this for the moment. So it's a very low-cost way to establish a position that somebody, the butterfly, like I like to say, is you hope it lands. It starts off kind of ugly, it's cheap, you hope it lands right where it is, and it turns into a beautiful thing. In this case, the Twitter has about a 4-to-1 risk reward, so that's very attractive. What I like to use them as, more often, there's probably two ways I like to use them. Is for a very short-term trade with earnings, when there's going to be a catalyst, and that the implied volatility is going to collapse right after the earnings event, and everything's going to go to intrinsic value. And in some of those cases, you can get a 15 to 20, risk-reward ratio. Cost you $2 and you can make 20 or something like that. Google's always the high-priced ones are always attractive just because the numbers always, open your eyes. Like, wow, for $2 and I can make, $22. The other way I like to use the butterfly spreads, it would be in the some of the indexes like the spiders, is then to go out maybe a month or two, probably not 2 months, but like a month, and go out of the money, and because it's so cheap, say, you know what, this is a good hedge. If the market comes down, I can put something on for 30 cents. I can do size. I can do 100 by 200, by 100 spread, and if the market comes down 5%, that's a very cheap way to get some downside protection. Likewise, it can be used upside, but more often than not, you know, you're looking to use that as downside, because overall, I like to construct. It took me a while. I was a dedicated short seller, but after the last couple of years, I realized that I like to construct my portfolio by having longs in individual positions and trying to marry it to some puts, some kind of put strategy in Spider. So.
Oh, okay. Now, since the profitability, the maximum profit on, or the maximum value on a butterfly spread is the width of the strikes. Now, do you stick to, I guess, like wider strikes that are further apart? Because something that I kind of messed up on recently was what I did on Facebook with just a 50-cent width, and I paid on each, you know, for each lot 4 cents, and then 4 cents in and 4 cents out, and it ate up so much of the profitability. So do you have any guidelines for, you know, the width between the strikes in these kinds of trades?
I think you want to try and get it as wide as possible, and one of the ways I do that is structuring, instead of a classic 1x2x1 structure, is doing what I call broken wing, or there's other names for it, skip strike. So you let's say, you know, in the Twitter, you could buy the 50 call and then spread it out and sell the 60, and then sell 3 of the 60, and then buy 2, 1x3x2, and you expand the profit zone. It also ends up being a little bit cheaper. But again, the big drawback on this is that you really need to land where the stock is going to be at expiration. So one of the things, the way I trade is I use technicals a fair amount. I mean, I used to be a guy. I started in the business, as you mentioned up top, in the pits of at the Board of Trade. I was standing in the bond pit, some of the grains, and then I had my point and figure chart. So, you know, I like to find support and resistance and target that on it. If it's, look at what the old support and resistance are, and then target that as the middle strike, where this, I feel like, is a good probability of it ending up. Especially on if it's related to using butterfly on earnings, you can then go and also layer in what are the options pricing in. Sometimes they're wrong, but at least that gives you a starting point. So the options pricing in a 7% move, 3% move. So you can then use that to try and decide what strikes seem to make sense. So if you get the options pricing in a 7% move, and that moves it right to an old support or resistance level, at least you have 2 things going for you. But certainly, you probably want to try and have a large width, you know, in terms of your profit zone.
Okay, so for earnings plays, did you say you use butterflies most common rather than things like straddles or straight call and put trades?
I don't know if I use them. You know, I've had some success with them, and I find them to be, you know, they're obviously, you know, because of the high risk reward, you know, in terms of a high reward versus risk, they're speculative. So it's a bit of a lottery ticket, but it's something to add to your repertoire. You know, sometimes I'll do earnings and just say, you know what, I'm going to buy, and what I won't do on earnings is just buy options outright, just because I think that too often you already have the premium, you know, in terms of the volatility is high, that's going to come out immediately. So if you want to do something that's purely directional, you really need to do some kind of a spread, and obviously a butterfly is 2 spreads. So you're really getting the benefit of a collapse in volatility, no matter what happens. The other thing in terms of earnings is if you really think that they're overpricing the move, you know, an iron condor would be the way to go, which would be selling 2 out of the money, selling a call spread, selling a put spread, hoping it stays in between those two and collecting the premium.
Okay, I'd like to tell the audience we will have a Q&A at the end of the presentation, so if you have questions, feel free to get them in there. But for now, we will move on to backspreads. So why don't you tell us a little bit about the basics of backspreads?
Okay, backspreads, great for taking advantage of a very explosive move, and they're right now with volatility relatively low, and everybody wondering, you know, we're going to have a market melt up, can the market collapse? These look attractive to me right now, and it's basically constructed of selling an option, whether it's a put or call that's in the money or at the money, and then buying a greater number of out of the money options. So the example we have up is in the spider, and we're looking at using it on the call side. So in this example, we sold one 181 call, and we bought 4 of the 184 calls, and the cost was zero cost. It was an even money trade. So that's actually very attractive.
Okay, I'll just remind people that this is just a random example we just did to show the math. We're not actually, maybe Steve is, but this isn't actually an official trade, so just to be clear.
Yes. Didn't do this. Actually, these probably are more effective on the put side, only because one of the things that a backspread takes advantage of is when there's a big move, implied volatility tends to go up, and as we know, that implied volatility tends to go up when there's a sell-off, even though the magnitude of the move might be the same to the upside to the downside. So we can look at this, in terms of your risk reward on this type of trade, is the maximum loss would be, the worst case scenario would be, is if the SPY is right at the 184 long call at expiration. That means the 184 call is going to be worthless, and the 181 call that was short is going to be worth its maximum value of $3. So you would end up losing $3 on that trade, but no more. It's limited. The other side of that is if you're directionally wrong and the market falls, you won't lose any money because, again, you did it for no cost. The upside is unlimited. The more that the SPY would rally, the longer you get. This has to do with that your long gamma, your deltas keep going up. Not to throw out all the Greeks, but that's part of it. You're long more contracts than you're short, so the more that the 184 calls become into the money, you're going to be longer. You're going to get more. The position gets more bullish the higher the price goes. So this again is something that is looking for a pretty explosive move in a short time frame. And if you want to just look down, I looked at some of the numbers today. I mean, we had the market down 1% today. This position, the call position here, lost 10 cents. So, you had a bullish position. Now, if you had done something similar on the put side, and I won't give all the numbers, but if you had done something exactly similar on the put side with the 179 to 176, where there was $3 between the strikes, 1 by 4, that position on a 1% down move today would have more than doubled. So that shows the power of these, because that you had the increase in implied volatility, and you had the fact that you own a greater number of contracts than you're short, boosting your deltas. Make sense?
Now, interesting you bring this up, because I'm seeing, I just pulled up, so the 180 SPY put expiring this month, I think is going for about $4. So, I mean, is there any reason to buy? I mean, so why would anybody buy straight puts rather than a back spread if the back spread?
That goes again towards what I would refer to as you don't know when the sell-off might come. If it comes early in the cycle, that's going to be best. But let's say we fast forward a week from now, and you can end up in kind of that nether region of where the SPY is between 180 and whatever it is you bought. When 180, you know, I was looking 179, 176. It could end up at 177. So you have the puts that you're long are worthless, but the ones that you sold are now in the money. So you can end up in that nether world, and so as time goes by, these become less powerful. One way to avoid that may be to calendarize it, but I don't want to get into that here. That's something we can look at later, because you know there's also that risk of if you carry it to expiration, and you're in that, one of the risks is if you carry it to expiration and you're in between the two strikes, you have the risk of being assigned. And so what you want to happen is the move to come early, fast, and fairly dramatically on these. So,
Oh, okay, but now would you avoid these with earnings, because typically after earnings, implied volatility falls? So is this something you would not use for an earnings play?
yes. So this would be the flip side of you know, let's say using a butterfly spread. This butterfly spread benefits greatly from a collapse in implied volatility. Back spreads benefit greatly from an explosion of implied volatility. So obviously, as you mentioned, after earnings, even if the move is beyond what options were pricing in, you rarely get a big increase in implied volatility. So I would not use back spreads as an earnings play.
Okay, and I will remind people that, again, we are going to send you that article series, because these very concepts, like the behavior of implied volatility and how that relates to specific strategies, is very, very important. So with that, we are going to move on to the Q&A. And first question is, do you ever trade covered calls?
I used to. Now I don't. And the reason is well, let's first of all understand that covered calls are no different than selling puts naked. The selling puts get such a bad reputation as, oh my God, it's unbelievable risk. They're no different on the risk-reward profile. And covered calls they've been promoted and marketed as such a wonderful way to boost income. And you know what? The S&P, the CBOE, they have an index, and it's not bad in terms of the performance. The problem is it extrapolates too often, that you're going to sell calls every month and it's a repeatable event. And the nature of the market has changed somewhat, is that stocks, when they move, they tend to move 5, 10, even 15%. And that can leave you scrambling, and suddenly you're adjusting, you're getting called, you have to make, there's decisions you have to make. So when someone says, well, you sell a 30-day call, you know, every month, and you're going to get 5%, and that goes out, and suddenly you're making 40% a year, I don't think so. If you want to do a covered call, I'm not against them. If you want to do a covered call, go out further than most people recommend. Go to a higher strike than someone might recommend. You know, what I'm saying, typically like a broker, money, you know, some kind of financial advisor might try and sell you on the idea of like, go one strike out of the money and you're going to end up making 40% a year. So don't think that these are repeatable events and extrapolate 30 days out to a year. If you want to do covered calls to boost your income and own the stock, especially on a dividend flow, something that pays a dividend, that's when it makes sense. Use 6-month options or something like that and go out, give yourself some room to the upside.
Okay, next question is, and we seem to get this one a lot, do you ever use do you ever trade any of the VIX products? Like I like VXX, for example.
Yes, reluctantly. You know, there was a recent article. You know, they're very complicated. You like to think that when it gets low, you have you know, you're jumping out of the first floor window. How bad can you get hurt? But due to the structure of them and the contango, it says it right there in the prospectus, they can go to zero. You just witnessed the VXX have a 4 for a reverse split. I think it's the fourth 4-for-1 split. So it's trading about 46 today. That's off of now a new original basis of 6,400. Granted, it was launched during the financial crisis when volatility was at historic highs. But, you know, I did recently put on a position that I sold puts and bought calls, and nothing changed in the market, and, you know, the puts have been drifting down to where they're close to being in the money now. So I do use it. I think you have to be selective. I think it's very, the two things I would say is the advantage it offers over buying puts as a protective measure, like S&P puts, is that you're not anchored to a stock price. I mean, you're not anchored to a strike price. But what you need to do is probably have better timing, is that when there's a spike in the VIX, especially recently, you have to take advantage of it, because we haven't seen volatility run up, trend higher for, you know, over the course of 3, 4, 5, 6 weeks in a long time now. So you have to take advantage. You have to be very quick on the trigger, that if you have a position on that you're long volatility and there's a 2 or 3 day spike, you probably have to take advantage of it right there.
Okay, so back to the butterflies. When you're looking at the 1x3x2 structure, does that make more sense than the standard structure if implied volatility is higher? Well, I mean, so I guess, will there be a bigger benefit from a fall in implied volatility?
It's not so much the volatility aspect of it, that it tends to actually cost a little bit less while expanding your profit range, that you have, you know, that you're going from it being that the spread's being equidistant to you're shifting it a little bit. So if my fingers can tell the story, is that the range where you can have a profit is larger than where, you know, the loss is. So that's why I like those. Again, that's probably something we can also refer to and go through it in an article and create a table to show exactly, you know, how the numbers play out on that. So it's not really a volatility issue. You're dealing with volatility. The volatilities are the same for both. It's about taking advantage of just expanding the profit potential, the range, where the profit range.
Oh, okay, and we got another. I think we briefly covered we covered this with back spreads, but why don't you briefly explain again? When does it not make sense to do a back spread?
I think, you know, like we said, is earnings. I don't think it makes sense. I probably prefer them to the downside, just because you tend to get the accompanying increase in implied volatility, and you know, anything that any particular stock that's trending up, that the implied volatility is high. It's really it's mostly a volatility play, and it's hard to say, you know, if there's a known catalyst such as earnings, the implied volatility is going to be built in. So that's something that maybe just as a market watcher, you have a hunch and you say, you know what, this is a bit of a flyer. Something may happen. Somebody doesn't know about a takeover. That might be a good scenario. You know, you start to see activity in the sector, and you say maybe these guys are a candidate. Certainly, you know, tech is always ripe for that. So in that area, I would say that makes sense.
Okay, we just have a few questions left, so ladies and gentlemen, if you have a question, you should get it in now because we'll be wrapping up shortly. So do you monitor unusual options activity?
I do. I look at it. I don't really trade off of it because there's just so many people are watching it, and also you have to drill down and find out, you know, is it closing out a position? Are they offsetting? Is it due to a spread? So just to scan for unusual volume, I would say no, I don't give that any credence. If there's something that says, well, there's unusual volume and it's just outright in one strike, there's no spillover to other strikes, it's in a strike that had no prior open interest, yeah, then for sure I'll take a look at it and say maybe this is smart money. Yeah, you have to be able to look and see whether they're doing stock against it. So there's a lot of things that you need to qualify it for, whether it's unusual just on volume or whether it's unusual because somebody actually thinks they know what's going on.
Okay, and that will bring us to our last question, which is, do you ever use risk reversals?
Yeah, the example I gave in the VXX that's a risk reversal, which would be selling puts, is doing two things that have the same direction. Selling puts, buying calls. So basically, it's getting along the stock. I mean, in the VXX, you can buy the VXX, but you're getting some leverage. You're also getting a little bit of a fudge, because if you sell an out of the money put and you buy an out of the money call, and it's done for basically an even cost. If the stock drifts down a little bit, you may end up, but it stays within that range, you lose no money. So it gives you a little bit of a fudge factor and gives you all the leverage of being outright long, the underlying. So I use them, but it's an aggressive strategy. I mean, it costs slightly less in terms of margin than doing the underlying shares.
Okay, well, that will wrap us up. We will send a replay. We will also send you links to Steve's articles so you can get more into the math of a lot of these strategies and get a better understanding of implied volatility and theta and all the other Greeks we love so much. So, Steve, do you have any final words for our audience?
Thank you for listening. I hope this has been informative, and definitely do not hesitate to email me questions, feedback. That's what all these websites are all about. I've been doing this a long time, and the best thing of all is to hear back from people. It gets me thinking, and hopefully, you build a base of knowledge. So that would be my one thing is, nothing specific about a strategy, but I would love to hear from everybody. So thanks for spending your time. And
okay,
thank you, Michael, for putting this together.
No, Steve, thank you. You are the god of options, and we worship you here, so thank you very much, and have a great day. And ladies and gentlemen, thank you for attending.